Now for our next task. On April 30th, 2017, the following bank statement arrives for the cash operating account. The company has some expenses, such as telephone expense, auto-deducted from their checking account. The transactions for these expenses are entered into the accounting records when the bank statement arrives. So our task is to complete a bank reconciliation in QuickBooks. So now we're looking at QuickBooks, and notice that the bank account that we're going to be reconciling is a cash operating. So let's look at the cash operating register just to kind of see what's going on. And to look at the register, we could go up here, double click on cash operating. We could go down to check register, choose a cash operating register here, or we could open up the chart of accounts, find the account, and double click it, and now we're looking at the check register for cash operating, and notice we have a few transactions that were entered in April. So our first question is, what is a bank reconciliation? It's simply where you compare the monthly bank statement to the transactions in the cash account in your accounting records, in this case QuickBooks. If there are transactions on the bank statement that you were not aware of, such as a monthly bank charge, interest deposit, and potentially automatic deductions for expenses taken directly out of your bank account, like an electricity bill, you would need to enter these transactions into QuickBooks. So basically, you're entering transactions that you were not aware of. So why wouldn't these transactions already be in your accounting records? You wouldn't know the exact amount of the electricity bill until you get your bank statement, so it likely would not be in your accounting records unless you had previously logged into your bank account, noticed the transaction, and entered it then. Many students ask why it's called a bank reconciliation. Let's look at the transactions in the check register of the cash operating checking account. Notice the balance, according to our records, is $26,259.38. But the bank statement has the ending balance as $30,480.40. Our job when we do a bank reconciliation is to figure out what the differences are and to bring them into agreement. That's what reconcile means, bring them into agreement. It kind of sounds complicated, but once you get used to it, it's actually very easy. So then students often ask, why would the bank be showing a different amount for our cash account than what we are showing on our accounting records? There are many potential reasons for this difference. We already mentioned a few of them. Let's first talk about the transactions on the bank statement that we did not know about. Perhaps the bank charges us every month to have a business checking account. In this example, notice there is a $10 service charge that is not in our accounting records. So we'll have to enter this transaction into QuickBooks once we start the bank reconciliation. Here's another example of a transaction that could be on the bank statement but isn't in our accounting records. Maybe the bank pays us a small amount of interest on our account. In this example, notice there's a $9 deposit of interest that is not in our accounting records. We'll have to enter it into QuickBooks once we start the bank reconciliation. Do you need another example of a transaction that could be on the bank statement but is not in our accounting records? Perhaps we have certain bills, like the telephone bill, that are automatically deducted from our checking account. Once we get the bank statement, the accountant's job is to enter the transactions into QuickBooks. So why would a business want an expense to be automatically deducted from the company's checking account? Well, for one thing, the transaction would never be late, therefore you would be avoiding late fees. Also, no check would need to be written or mailed, and it's one less thing for the accountant or bookkeeper to have to remember to do. In this example, notice there is a $75.69 deduction that went to Twin City Telco that is not in our accounting records. We'll have to enter this telephone expense into QuickBooks once we start the bank reconciliation. So those are examples of transactions that could appear on the bank statement but would not be in our accounting records. On the other hand, it's possible that we have entered transactions into our accounting records that did not show up on the bank statement. One common example is called a deposit in transit. This is a deposit late in the month that did not appear in the bank statement because the statement was printed before the bank could record this transaction. So the result is this deposit would be in our accounting records but would not be on the bank statement. Now there are no deposits in transit in this example, but there will be one when we reconcile the company's cash payroll account in a future video. And finally, another example of a transaction that would be on our accounting records but not on the bank statement is called an outstanding check. This happens when we write a check, record it in our accounting records, but the person we wrote the check to has not cashed the check before the bank statement was printed. Because the person didn't cash it yet, the bank is not aware of its existence and therefore it's not on the bank statement. We'll find out later that the outstanding check in this example is check 12, written to Williams Office Supply at the end of April. Notice it does not appear in the bank statement because it wasn't cashed before the monthly bank statement was printed. It would appear on the next bank statement, assuming that Williams Office Supply deposits the check in time, which of course is very likely.